Joining us now is Goldman Sachs tech analyst Eric Sheridan. He has kept his buy rating on Amazon, but lowered his price target to $230 a share from $250. I mean, we finished today, Eric, just below 168. Why do you feel confident that this is still a name to own right now?
Well, number one, thanks for having me on a Friday late in the afternoon. It's great to talk to both of you. Second, AWS is reaccelerating this theme around cloud computing as an output of the AI investments and hyperscalers seeing both putting cloud optimization in the rearview mirror, workload migration picking up at the enterprise level, as well as AI workloads starting to pick up and generate growth. We believe is still an underappreciated story. We don't think this is the end of the reacceleration growth story at AWS, and not only are you getting 19% growth, but you're also getting a mid-30s GAAP operating income margin at the same time, and we don't think AWS is valued as if it's a rule of 50 plus company inside Amazon as the first point. Second, while the consumer is becoming more volatile, and while there was a lot of noise around operating income this quarter, we would say the long-term thesis around a rising operating margin and Andy Jassy's commitment to delivering a mixture of a return to operating margins to pre-pandemic levels, as well as the advertising business contributing more margin than just that narrative, is still well intact. So we still see a pathway to GAAP earnings and operating income margins that look, believe it or not, relatively cheap on earnings as you look out over the next 2 to 3 years. We have a $6.50 GAAP earnings number for 2025, almost $8 in 2026 against less than $170 price today.
Yeah, I mean, it's interesting when you lay out the thesis for Amazon, and you can argue that it's been similar for some of the other Mag 7 names that have reported in the past, call it week and a half, is investors have been really nitpicking and really going through line by line and honing in on very specific metrics, and that has been triggering the selling. Even when there's been top and bottom line growth and growth in things like in the case of Amazon, AWS, which is always typically the thing that drives the stock in one direction or the other. We were just having the conversation with Bob Elliott about stocks having an expectations issue right now. And I wonder how you see it, especially on a day where you have Elliott putting out a client letter saying NVIDIA's in quote-unquote bubble land and being skeptical of AI and calling it overhyped, with many applications not ready for prime time.
Yeah, I can't address the Elliott letter, but I think at the end of the day, what I would frame up for investors is, yes, there is a nervousness. There's certainly less patience for narratives to play out. I think there's elements of when can I get a return on some of the spend that's starting to work their way into my investor conversations, and we understand that narrative. You know, almost every technology and computing shift that I've been through ends up with moments of product innovation, followed by build cycles, followed by a little bit of disillusionment, and those play out over multi-year themes. So patience is running thin. There is not a lot of willingness to underwrite less linear narratives, and when you get a little bit of noise in something like an operating margin in Amazon, it does lead to a sell-off on a one-quarter view. But we would tell investors to zoom out a little bit and see the bigger picture that's of compounded revenue growth and compounded earnings growth that could play out here, irrespective of the AI theme at Amazon over the next 3 to 5 years.
Eric, I was about to say I was surprised in the investor reaction to Amazon relative to Microsoft, because I felt like Microsoft was way down on the numbers, but then after Amy Hood put them into context and what was coming, it went back up again. But I just checked, and they're both down to about early February levels. They've lost 6 months worth of gains almost exactly. Any significance to that?
Well, I think that speaks to the broader point, and it's a good point, John, is that you're basically retracing back to levels where people feel a little bit more comfortable with what they're underwriting in terms of compounded growth and where there might be more visibility. But to contrast it with another name even just this week, look how positively Meta responded to no caveats, no hiccups with respect to the advertising business. And you contrast that with a quarter ago. Meta sold off a quarter ago when there was a little more noise in the advertising business and there was a little less patience with the AI investment. Fast forward 90 days, it reacts very positively this week to very stable advertising revenue, no misses against expectations, and just as elevated an investment narrative from Mark. And I think it's all about elements of expectations, how our core business is operating, and then layering in the investment theme on top of it. That's what's driving a lot of these reactions.